This week, the Aussie dollar fell to its lowest point against the US dollar since January 2017, close to 73 cents. Once again, much of this was simply due to the strength of the greenback, but there was also some pressure from the slide in the Chinese yuan. Since early 2017, China has fought a successful battle against the yuan weakness of 2016, placing a priority on restoring domestic confidence in the currency, even at the potential risk to export competitiveness. Capital outflows have been clamped down upon, and the yuan has been kept in tight daily ranges against the US dollar. Measuring the yuan against a basket of other currencies, it followed a clear appreciation trend from about August 2017 to as recently as mid-June 2018, when it reached a high since February 2016. What happened in the middle of June? Of course, it was the FOMC and ECB meetings. This critical 24 hours is still reverberating in FX markets and seems likely to continue. While other major central banks are tentatively on a tightening track, for example the Bank of England and the Bank of Canada, there is no rival to the scale of the Fed's tightening track. Since the 12th of June, the eve of the FOMC decision, almost all major currencies are down against the US dollar, including a 3% fall in the Aussie. Within Asia, it is very notable that the yuan is second weakest, down 3.5%, given China's previous preference for appreciation. This, of course, raises the question of whether this is one of China's responses to the ongoing trade battle with the US, ahead of the imposition of tariffs on $34 billion worth of Chinese imports on the 6th of July. Whatever the motives behind the yuan's fall, it has added weight to the Australian dollar. A quiet local calendar kept the Aussie focused on offshore developments such as trade tensions and some softness in commodity prices. The strong US dollar, backed by the prospect of further Fed rate hikes, also pressured the Aussie. This was also a factor in the Kiwis' fall to two-year lows, but most attention was on the Reserve Bank of New Zealand's policy statement. The RBNZ said that the next move on interest rates could be up or down, and sounded a little more gloomy on the economy. In the week ahead, the RBA seems certain to keep its cash rate at 1.5%, but there'll be interest in the statement on factors including the pressure on mortgage rates from the rise in banks' funding costs. In terms of Australian data, we will see May updates on retail sales, building approvals and the trade balance. Internationally, we will keep watching US-China trade tensions and the European Union summit, which has placed pressure on German Chancellor Merkel's leadership. In the US, after the Independence Day holiday, the focus is on the June employment report. Another strong reading would reinforce the strength of the US dollar. We'll speak to you next week.